Oh, bugger, we are recording. Ladies and gentlemen. I'm sure there are no ladies, but anyway. It is Hugh Hendry, and it's the 3rd of November. I think it's 2 days before we start having the higher echelons of the American judiciary weighing in on Mr. Donald Trump and his tariff frenzy. Is it allowed? Is he going to have his wrists slapped? Me? It's 10 o'clock. I'm resigned to my fate. And you know what? I get confused with the P's. Lots of P's. This evening, have I been procrastinating? Or have I been prevaricating? Truth be told, and I don't like that expression, but I think it's appropriate because I could try and bluff it, but I get confused by the two, and I had to do the chat GPT. Procrastination, as you all know, is delaying something, putting it off, something that you should be doing. I have been procrastinating tonight. I put off the preparation of this blessed sermon. I put it off all day, not because I'm lazy, not because I'm gallivanting. I'd love to think I was, because I'm working on other things. I am presently, as if you care, but I'm presently trying to reopen my grand house in St. Bart's, it has sat idle for 2 months, taking a well-deserved rest. And we have been polishing and scrubbing and putting varnish like lipstick on a beautiful lady. I think I had about 20 odd people working here today. So I've been procrastinating, not prevaricating. Prevaricating is to speak in a deliberately vague or evasive way to avoid telling the truth or giving a direct answer. Now, I can imagine some of you, not all of you, but some of you may actually think that that's what I do. I prevaricate because I speak in riddles. But I've had George Gammon staying with me. I mentioned that the last time round. He's gone off. And I was meant to join him in New Orleans. But such is the overrun and the task of putting this precious house back together. And quite frankly, such was my dislike of listening. If I'm going to a conference and I've got the stage, I'm cool with that. But don't expect me to sit in the audience. I'm not cool with that. Unless you've got Stan Druckenmiller or some of the greats. And sadly, they were not gracing the New Orleans conference this week. The conference that George tells me has been graced actually by some amazing people like Margaret Thatcher. But I don't believe there are any Margaret Thatchers presenting this week. So I'm staying put. And so you're more than likely to get 3 transmissions this week from me. I get turfed out of the house on Thursday. I take on my other residence, which we call the ghetto. It seems like a ghetto by comparison. Anyway, that's a hell of a long way round of saying, and I'm sure I say this. Oh God, I'm going to have to try and increase my font size. Command A. Font. Where are you? We need. And you know George, who Gigi, who's a guru in the who knew in the complex guerrilla warfare of dating. George doesn't with those whiteboards of his he doesn't just examine the sophistication and complexity of the Fed's plumbing. No, he examines the great mystery of how we approach the beautiful sex. And talking of font, he was telling me I've got to get one of those screens that no one can actually eavesdrop or like kind of see your screen because my font is huge. And I put my font on to 24. And even a big font, I don't think is going to help me. Try as I have. I mean, I went through the weekend Financial Times. I went through today's headlines. Earnings reports. Yes. The prodigious OpenAI ChatGPT. Oh my goodness. It is a one company industry that seems to be sustaining the world, the global economy. Over the weekend, they reported a breakthrough deal with AWS, the Amazon cloud business. That previously we thought that was off bounds because of the Microsoft connection, the Microsoft shareholding with ChatGPT. But no, such is the need of a hyperscaler that they've struck a fugazi-wugazi deal. I'm getting fed up with them. I think $1.5 trillion. I mean, say it quickly, it sounds believable. And, economic data, apparently I'm here to discuss the economic data. And I know what I'm going to say. There wasn't much economic data. And again, it's with trepidation that I suggest to you that maybe we got another blip recording from the S&P, the global US manufacturing PMI for October. Did we get it these days? I don't know. The computers who run the game, they make things up, and I'm not that attentive. But I'm going to read it. It was 52 and a decimal point, and that was up a little bit from 52 and another decimal point. I did read, and again, it may be a hallucination, but it sounds kind of realistic. I did read that in the UK, manufacturing output finally, UK is a basket case, finally expanded. Manufacturing expanded. The first, let me say it slowly, in the UK, manufacturing marked its first month of expansion in a year. Well done, the UK. And then, you remember with my word salad the other day, good times and bad people. I didn't like that, bad people. And thank you so much. You've been coming in and correcting me. And I think the source of that comes from, the fourth turning, the fourth, the fifth, the sixth, the fourth turning. That fourth turning's been promised to turn for a long, long time. Good book, interesting, provocative book. Good book might be strong, but provocative book. But provocative books are good. I'm going to say that. Hard times create the strong man, and the strong man creates. I'm sure this has been made up. This comes from my dear friend, the idiot, my friend. In fact, in honor, forgive me a second, but in honor, oh my God, I do hope this is recording. In the honor of the idiot, I am wearing his goggles, of course, to see. Oh my God, I can now see the future. Wow, there are things I've got to tell you. Thank you, the idiot. And if you're listening to the podcast and you're not on Substack, so you're not seeing the video, maybe you're not missing that much. But it's the weak man, not the strong man. The strong man creates, is that a typo? Gut times, good times. and the gut times create. I think that must be good. He is an idiot. Stop being an idiot. Good times create the weak man. I tell you, it feels like Trump is a strong man. And we're just talking about UK manufacturing. Actually, I must take notes. It's 10:07, so I've been yapping for a few minutes. The US is the strong man. And you got to think in the UK, Keir Starmer, oh my God, that feels like a weak man. A weak man that, even with a huge political majority in the House of Parliament, he's so weak. He's a dither, and he dither dathers. Are you familiar with that expression in America? People who dither and dather. And now here's a question: are they Yeah, they're procrastinating. They're delaying or putting off reality. Can't find himself to take on what Margaret Thatcher did. The lady wasn't for turning. She used her majority. The establishment, the economists, said her policies would drive the economy into the floor. And those elites were rather ignoring that we were in the floor. We'd been down. We'd been down so many times that down felt like up. Mr. Rolling Stones, Mr. Jim Morrison. How wrong those elite economists proved to be. Heavens, I'm now vibing, I'm up and I'm running. And my kid, Cam, who is completing his politics, philosophy, and economics, he was saying, "Oh, got to write an essay on the neoliberal." Now, liberals mean different things between Brits, and they mean the exact opposite between Brits and Americans. But to write about the neoliberal advance or explosion or the phenomena at the turn of the 1980s. And so Thatcher and Reagan, strong people. And the strong people who were willing to take on controversy to try and pursue what they thought was the right thing, despite the touching of the intellectual middle ground. And again, that feels a little bit like Trump today. It was remarkable, but the reticence on the part of my son. I don't want to say fear. He's not a fearful kid, fearful young man, but he's like, geez, the prejudice in UK academic world. I mean, the last week, of course, they had masks in the university, in the PPE. I don't know which part of the faculty it was. Maybe it was politics. Maybe we could justify some element of it. But would you believe the lecture? My kid had got out of bed early. He's there. He's sitting in a big lecture hall, Manchester University, a highly regarded PPE institution. And he has to listen to kids, his peer group. They've got masks. They've got stupid COVID masks and other kind of military paraphernalia. And of course, they're promoting the Arab cause. Really, is that the time? Is that the place? Shouldn't we actually be having the professor discuss the intricacies of neoliberalism, the good points and the bad points? But there's a universal rejection of neoliberalism in many quarters presently in the United Kingdom. And I think the economy suffers for that. I'm sure that the idiot agrees. No, and I've got some notes. I'm going to go back and forward. I'm sure. I mean, if you're busy, if you've got better things to do, I don't know. Move on. I'm looking again. Would you believe? I mentioned this. I love CarMax, an American retailer of, I believe, secondhand vehicles. We've discussed it before. But whilst George was assisting me with my sexual market value and how to use it, and I will tell you in a minute just how I did not. I diluted my. I'm pretty sure I diluted my sexual market value this weekend, much to Mr. Gammon's disdain. But he was telling me he's been short. Let's call it Karl Marx, the political theologian. GDP, the capitalist GDP will plateau. You will have a plateau in your prosperity, and then you'll have to work out a new form of distribution. We'll all become Marxists. We'll all become Marxists because we're not buying secondhand vehicles from CarMax. And actually, linking into that, my great buddy again, Steve Murren, I saw a clip from Bloomberg, an interview with him. And of course, in this world, I saw it through the vagaries. I saw it through the lens of Instagram. That's where I get all my best ideas. And again, Steve's making the same point because they were pressing him saying, "Hey, why are you the one why are you the troublemaker? Why are you agitating for the big interest rate cuts? You're just Trump's man. You're just the yes man. You're taking on your instructions." He's like, "Well, thank you very much for the insults. May I say, I have a brain, I have a voice, and I can talk for myself." And my point is that demographics and immigration, the expansion of the population, it's a slow moving thing. Glacial, even. And yet, we've had concurrent 3-year periods where it's been anything but. When I say concurrent 3-year periods, a 3-year period of a great rise in population and a 3-year period where it has reversed. And what we've seen in those 3-year periods have been movements that we normally capture when the lens is set to measure 30 years. So we've had 30 years of population movements condensed into 3-year periods. And we have to be cognizant of that as an interest rate setter on the board of the Federal Reserve. And we have to be cognizant of that because it affects this thing called many things, R squared. Let's call it Charlie Wonka's golden chocolate bar. Let's not actually. Let's call it the kind of neutral rate of policy rates, Fed policy rates, where you're Goldilocks, where it's neither too hot or too cold, where it's just the right level. And he was saying that so when you're getting 30 years worth of positive immigration, your natural rate of policy rates is higher than you think, and you've got to be adjusting that. And vice versa. When you get 30 years worth of contraction in the population, then you can't wait and think about it and seek data dependency and observation. It's like your natural rate now is, because your natural rate was set on this kind of 30 year of immigration expansion, and then it's flipped, and the flip and the speed of the subsequent contraction is again of 30-year significance. Like, we're all over the place. You can't be stationary. You can't be pensive. You can't be laborious. You have to be saying, hey, the R squared, the kind of neutral rate of policy, went up a lot and it's now come down a lot. And if we're not ratcheting our federal interest rate policy quickly, then we will, perhaps without knowing it, be having we'll either be boosting and we will be pro-cyclical. We'll either be boosting or we will be accelerating the deceleration in economic growth. So that's why he has been a proponent of greater Fed cuts and more rapid Fed cuts. From the last meeting, that is very much a minority view. And for whatever reason, I'm not sure what the reason is. But I was going to say, I'm not sure what the reason is. Why the Fed decided to cloak the most heralded 25 basis point cut. Like, there was no surprise. We knew that for the month of October. We knew they were going to cut. The surprise was the injected ambiguity with regard to further cuts before the year end. Let me see if I can answer why they might have chosen to do that. I had said to you that 1 year previously, it seemed when they cut interest rates that they had the intent to shock the market and to convince the market that they were behaving recklessly. And the hypothesis for why they would choose to act recklessly was that they wanted a steeper yield curve. They wanted the 10-year Treasury to go back up in yield, having seen it be as low as 3.6%. And that they had probably felt, and why did they feel? But they'd probably felt there was a need for interest rate cuts. And the compulsion and that need was the surprise which had occurred in the springtime of last year when the American inflation data very decisively decelerated. And it threw into light the notion that the real rate of Fed policy rates was actually real and positively high, and therefore probably did require a reduction at the short end. But as the Fed surveyed the strength of this AI and fiscally pumped domestic economy, the last thing they wanted was a flat yield curve with the 10 years comparable to the 1 year yield. They didn't want parallel declines lower in that. A, because it's not good for bank profitability, and B, that they were fearful that if that 10-year breached 3.6 and went to 3 and went to lower, that it could resuscitate a very large part of the American economy, which has not participated in the very strong rates of economic growth for the last 3 years. And of course, I'm talking about the housing market. And I think we did mention that on one of the podcasts last week, that existing home sales, no one's moving house. It's not a true statement, but comparatively, there is no vigor in the rate of not wife swapping, but house swapping, because people can't afford the mortgage. The mortgages have stayed, the 30-year mortgage, which everyone had fixed at 3 and less in 2020, 2021, is stubbornly sitting there at above 6%. And so no one wants to forgo the cheap heritage of mortgages from 3, 4, 5 years ago just to move house. Karl Marx. George has enjoyed. I hope George doesn't mind. I'm sure he sometimes listens when he's training, but he's in New Orleans. So he won't be listening. So George has been, and he was not gloating. George is just a wonderfully nice person, but he had been running a pairs trade. He was short the Karl Marx or the CarMax, and he was hedged with a long position in the S&P. And it's worked rather well. I'm looking at the CarMax chart now, and CarMax has declined from, I don't know, my God, that is such a small, I can't even read that. Oh my God, even with font, it's impossible to read. Seriously, oog, how can I not read that? So, trust me, it is. Trust me, I speak on a podcast for the blind. I am the blind leading the blind. Oh my God. CarMax has declined from, oh my God, I'm going to have to go into another screen, and I'm in my chart screen. I'm looking at Solano. Remind me later to mention Solano. What do they call it? CarMax. Oh God, no, there's no CarMax. It's not Caro, C-A-R. I'm doing that thing which is really boring. I'm just talking to myself. Don't do it. It's KMX, and the KMX, oh my God, the KMX price, I'm looking at it. It was 94. These things we call American dollars. In, I think, March of this year, and it's 41. It's halved. It is halved. And quite recently, of course, it must have had a profit warning, and it's fallen. It fell from like 60 to 45. Ouch. So well done, George. And maybe this will become a theme of this conversation I am having with myself. There are times when making money in markets is rather independent of what you're doing. You've got risk, and risk is multifaceted, and you're rewarded. There are other times when you can be the damn smartest person on the planet, and you will not make a dime. In fact, you will probably lose money. Presently, we are in the former. We're making geniuses of everyone who's turning up every day for risk. And so I was like, oh, George, we don't like pairs trades. He's like, oh, really? And he was a bit crestfallen. I was like, but why? I was like, well, let me tell you. I did actually try and take notes on this. So I'm sure, first of all, because there is I think actually I can sew everything I've said so far together. The CarMax had been a great stock before it halved, and it ties into Steve Mirren's point that we had 30 years worth of positive immigration, and these new entrants, mostly, probably 99% economic migrants looking for a better life, needing a car, but probably not really being able to afford it. And so they're not buying a new car. They're buying a used car. And so CarMax is going to feel 30 years worth of immigration force within the last 3 years. Share price says it felt it. And the share price decline this year, again, very much like Steve has been saying, is confirming the reverse, the 30 years of rapid contraction, these people either being said or deciding to leave, and leaving these cars, if you will, behind. And we are seeing confirmatory evidence of that kind of behavior in car leasing, in credit, high risk credit lending. We're getting bankruptcies and we're getting signs of distress. So CarMax, Steve Mirren, 30 years compressed into 3, kind of all tying together. Federal Reserve, if you're listening, we probably need to get the natural rate of interest is not 3. And this is one of my profit themes, if you will, for the coming year, that at the end of 2026, the presumption by the eggheads is that the Fed policy rate will be at the natural rate of 3. And I'm with Steve saying 3 ain't the natural rate. If you're at 3, you're going to be inflicting a more widely felt recession and an unnecessary recession on America. Let's not do that. And so I don't think they will do that. And I think Fed policy rates could be certainly less than 3. I think less than 2. And I would say there's a rising probability that they could be closer to 1. Anyway, so it seems very logical, right? Be short this distressed company and hedge, take out the market beta by being long the beta. But the thing is, logic doesn't cut in this world. I mean, that's kind of why I survived and kind of prospered until I didn't. So, and this is something, again, I want to discuss. Most likely, between now and, I don't know, the tomorrow of woe, it's going to be a big sell-off. So there's a kind of uniformity about the melt up when we discussed Paul Tudor Jones. And I kind of buy into that. But if there's a melt up, and I was being flirtatious with S&P 10,000, why not? But the S&P will not get to 10,000 this side of like the next 36 months. It will not get to 10,000 without having pretty severe price reversal. Something the magnitude of what we saw earlier this year. I think we had a 25% price reversal. Near as damned it from kind of January, February highs into April lows. That's what Meltups do. The high volatility momentum stocks, they half and then they double and more just to check. It's like, again, Jesus telling the apostles, you will reject me. And the cock will crow. The cock crowing is the price reversal and the inability of the believers, the true believers, to ride such reversals. And so these big sell-offs, the S&P will produce a Z-score of greater than 3. Remember we discussed Z-scores, which is we're every day we're kind of looking back and we're getting lots of observations and we're trying to determine what normal is, what a normal market price regime is. And when you get Z-scores of 3, life ain't normal. A Z-score of 3 is you're kind of like 3 standard deviations from the norm. Think of those bell curves, like way out. You're way out in the long grass. It's unusual that you find yourself. It's unusual. When I say unusual, like if you think of the area captured under the bell curve, when you're right out there, there's not much. I think it's like in this hypothetical world, ceteris paribus, this rational world, You should only be experiencing 3 standard deviations, like 0.13. I've got to use 2 decimal points, 0.13% of the time. Price is not wrong, but those kind of price changes are rare. You know that saying, it's a 1 in 1,000 moment? No, it's a 3 standard deviation from the norm moment. How rare. Sometimes it feels magical, mystical leap. It always ends with a splash. And and what happens is when suddenly 1 in 1,000 events are happening, you're like, that's not meant to happen. In the bigger, I was going to say sophisticated, but I don't know. In the bigger, well-staffed financial speculative organizations, risk departments come in and they say, you know what? I thought I understood this market and I was happy to underwrite the speculation and the risk taking of all you cavalier cowboys out there on the trading room floor. But I don't understand this market, and I'm bringing you in. I'm taking rope. I'm taking your risk position size down. I want you to reduce your gross exposure. And do you know what happens? So to contract your risk taking, you've got to reduce your shorts. To reduce your short, you're buying. You are buying the stinkiest companies in the marketplace. And you are selling your longs. So let's look at that and imagine George's, poor George. I do hope he's not listening, but imagine George's pair trade, CarMax and the S&P. And let's look at, I think these are 3 standard deviation movements for the S&P. April the 9th, 2025. S&P's up 9.5%. CarMax is up 9%. Cool. Your George's strategy has paid off. Consider April the 4th. S&P falls 6% in a day. I think it does, unless this is the dreaded AI hallucinating, but probably did. So you've got a long in the S&P and you're down 6%. So that's cool because thank God you're short, and you're short that piece of junk Karl Marx. Except it's only down 1. So you've lost money that day. You're principally short something, and you've just lost money on one of the stickiest, ickiest days since the dark days of 2020, 2022. November 10, 22. S&P's up 5. CarMax is up 9. So you get periods where you get double smashed, both sides, and you think you're looking at the world on your net exposure, and your net exposure is 0. But there are times when it's actually you lose money on your long and you lose money on your short, and so it's your gross exposure. So say you were 50% long and 50% short, you're like, I've got 0 exposure, but actually you're 100%. You've got 100% exposure. And when you get those 3 standard deviations from the norm, my God, do you get your ass whipped? And so then the other issue that I had with the CarMax is like, well done. The stock has halved and it trades today at like 40, 41. And the 1-year moving average is 64. So that's $20 away. like if the stock returns to the 1-year moving average, that's a 50% rally. And if it's a 50% rally, I'm not sure the S&P is going to rally. I'm pretty certain the S&P is not rallying 50%. So I don't like its deviation to the 1 year. That's how I define risk. Being short Karl Marx has got nothing to do with my long position in the S&P, and it's got everything to do with the notion that it's trading at 41. And okay, so the 1 year moving average is 64. Now, in 1 month's time, 2 months' time, 3 months' time, of course, it's going to be capturing this waterfall decline in the spot price. So the 1 year is falling. It will be 55. It will be 50. It will be 45 in the course of time. And I'm willing to bet nothing just falls to zero unless there's fraud, and that's very, very rare. So most likely, CarMax will have a rally, and it will trade closer to the 1 year moving average. And most likely that will occur during a big sell-off in the S&P. So that's why I would not favor a trade like that. I hope that makes sense. I don't know if anything I say makes sense. I'm looking, I've got March 16 down 12%. What was down 12%? Let me just look at the stock. March 16 is actually that's another year, I think. Oh, that's 2020. My birthday's on March the 16th. I am a Pisces. And just think of that back in the COVID time, March of 2020. And I said to you that, again, we'll finish this conversation on the Z scores, but you get evidence of kind of like profound trend change when you get these Z scores. Like there's a disturbance in the universe, and the disturbance is a lot of volatility. So March 12th, 2020, S&P declined 10% in a day. March 16, it declined 12% in a day. And then March 24, it rallied 9% in a day. And of course, it then launched itself to the moon. So minus 10, minus 12, plus 9. You had a cluster, you had a constellation of what the fuck just happened moments, which would have caused involuntary trading. And markets, they don't pursue logic. They don't pursue reason. I mean, maybe they do over the course of time. They certainly do over the course of time. But a bit like your solvency and Keynes, they can remain a little bit irrational longer than you can solve it. And so we have to be careful. All right. I'm just gonna pick. This is like I'm doing what I believe Mick Jagger and David Bowie did occasionally when their protagonists, musicians, had created an amazing vibe. I'm not suggesting I've created an amazing vibe, but and they were the lyricists. And they're like, oh my God, what am I going to write? And they had this thing where they take wow words and boring words, and they'd write them on cards, and then they would throw them into a hat and mix it. You must know this story. And then they'd randomly take the words or the little phrases and they would create lyrics. Love that. So that's what I'm doing. So apparently the S&P 500 averages a gain of 1.8% in November, which makes it one of the strongest performing months. Did you know that? I've just seen actually that And I've just remembered. So again, talking about Steve Miran, talking about Karl Marx, talking about the natural rate of Fed policy rates. The great Treasury Secretary Scott Bessent was interviewed over the weekend on American television. And he quoted a survey saying that 42% of the pandemic inflation, when prices surged to 9%, academic studies reveal that 42% of that inflation was caused by excessive government spending. And Scott was very, and well done him, quite deservedly. He was proud that they had, at long last, managed. The US government runs to an end of September fiscal year. And so for the fiscal year just ended, the budget deficit as a percentage of GDP has fallen marginally. But it was the first year in 5 where spending actually contracted as a percentage of GDP. And so thanks to tariffs. And actually I found it quite repulsive having to go through the weekend FT and these smug and annoying articles that suggest that actually, what did we learn last week with the US-China standoff and resolution or deferral for 1 year? Apparently, again, according to the elites, the center ground, who are always wrong, China showed them. China had confirmed it's now a big boy at the table. China had faced off Trump and America. America now has to deal with a tougher foe. So one thing about that is, you can't prove a word of that. Which then makes me think, it's just prejudice. It's just opinion. And it's quite a revealing opinion. Scott was saying, hey, with the tariffs, I've given you the precedent, I've given you a fiscal year, and we've started contracting. And remember, yes, the big fat spending bill is despicable. Has many, many despicable aspects, but also has it's not gerrymandering, but it's very much created to, if you will, assist the Republican Party when it comes time to be re-elected. And of course, there's a major political cycle going on this time next year. And so there's front loading of spending from that bill in the here and now, which will then be displaced by cuts, by actual cuts, which will then reveal a fiscal prudence. So it's like Saint Justinian, I want to be virtuous, just not yet. I want to be virtuous in the eyes of the voters in about 18 months' time. So with tariffs running at $30 billion a month, maybe, that government spending is now dropping. And that academic report suggests that with spending in the abeyance, that inflation, the fiscal policy will be a 1 and 2 factor in contributing to lower inflation. So again, Scott was very much saying, in agreement with Miran, that I think we're overstating the natural rate of interest. And I think on the inflation front, the government is doing its part to ensure that inflation is going to be closer to 2 than 3. And so there was an appeal for the Federal Reserve to act with the Treasury. The Treasury was acting in a manner which could be described as disinflationary. And believe me, you've got to take that with a big dose of salt. But the Fed, therefore, should be kind of trying to lean into the efforts of the Treasury to reduce spending. And the Fed should be reducing interest rates. And he was asked, are we in a recession? Is America in a recession today? And to which his answer was a little bit mealy, but it was, there are parts of the economy which are in recession today. And very notable. The standout is the housing market for all the reasons I've just mentioned previously. So again, I was thinking, when we are taking risk positions, we want to be in areas which are sponsored or very much pro the government's intentions. And the housing market, it would seem, is very much the United States government demands that the housing market no longer be in recession. And so maybe we should be thinking about having a greater representation to housing stocks, which have actually been great. There's a great long-term argument for housing stocks. The US is undersupplied in housing. It's just that they're just too damn expensive to acquire just now, with the financial rate, the mortgage rate being greater than 6. Remember, greater than 6 with inflation trending to 2. That's high. That's punishing. And yeah, I was randomly looking, for exposure to the housing market. And again, you being European, I'm not familiar with some of the names. Martin Marietta Materials. I thought Martin Marietta was a defense company. I think maybe it was a conglomerate in the 1960s. But now it focuses on construction aggregates, heavy building materials. It's cement. And remember I was telling you about Amphenol, a stock that I actually had come across it in the past, but I hadn't looked at it in a lifetime. And I was applauding and salivating at just how exceptionally good the chart was. What is an exceptionally good chart? The absolute price begins in the bottom left-hand corner and it ends in the top right-hand corner. And you were talking about Z-scores, the variation in trend. I mean, you can put a straight sloping line on it and it just hugs that line. It just goes up with very few deviations. And Martin Marietta is one of those companies. A very, very good long-term performer. Today it has an enterprise value of $42 billion, about $5 billion of debt in there. It makes kind of 30% margins. You're paying 5-6 times sales. So the convention is we would take that 30% margin, we would divide it by 5. And so we're starting with a 6% return, and earnings are likely to mimic at least nominal GDP. And so our long-term return looks like 12. And a 12% return is kind of the return of the S&P over the last 15 years. And that's exceptionally good. I mean, you're almost doubling your money every 5 years. And the challenge for us asset capitalists is maybe that we would seek to buy Martin Marietta Materials on, God forbid, a profit warning, on a Z-score, on a 1 in 1,000 event, when maybe it sells off 40% and you can pick it up not on 6 times sales but 3 times sales, and then suddenly we're looking at much higher expected returns. Anyway, Martin Marietta caught my eye. The share price caught my eye. And it's another one, forgive me, I'm just looking at the chart, but it's another one that clearly it peaked with the overvaluation of the housing market in 2006, 2007. And that peak in late 2007 or 2008, of course, remained outstanding for about 8, 9, 10 years. But my goodness, the ceiling became a floor and it became a very coiled share price, which then moved from about $170 to about $620 today. So these breakouts of compression, of 10-year compression periods, oh my goodness, as I sought to demonstrate with the charts of Japan, can be very, very powerful. And then this, I mean, I shouldn't even mention this, but I was kind of trying to find earnings announcements today where companies were extolling or discussing how AI was changing the operational landscape. The companies have earnings and their chief executives are sent out into the world of finance to broadcast tales of woe or tales of wonder. And I did come across another pharmaceutical stock. You know, I'm kind of keen. I'm warming to what looks like an emerging breakout in the universe of pharmaceutical research and development. And the hypothesis would be that the computing power and the intelligence of the machine will help accelerate the advanced discovery of wonderful new medicines. And so I came across a name from the dreaded pandemic, BioNTech, I think it's called, which has had a torrid time since the pandemic. And we like that. And it's fallen considerably. Again, I can't read the scale, it's way too small. But that's a stock which is beginning to move. It's been moving sideways for the best part of 3, if not 4 years. This $24 billion stock, which, if my free data sheet is anything to go by, it tells me it actually has 10 yards of net cash. Really? Interesting. But they were saying they actually had an AI day, InstaDeep, and they were showcasing how they're scaling and deploying to try and find personalized cancer immunotherapies. BioNTech. Who knows? AI and its how it changes the world for us. We've seen not just the people who came into the country, the immigration now leaving, and its ripple effect on the job market, the housing market, rentals. But I took another bubble type picture out of today's newspapers, which was the number of private sector employees working in information and professional and business services. The fabled white collar workers of America. And a lot of these professions are deemed to be very vulnerable to the intelligent automation strategies of AI. And so there was confirmation in the ADP payroll processor in their surveys, which show that those white collar jobs have declined between January and September this year, despite a net addition of jobs in the American economy. So Trump is creating a lot of blue collar gains. You know, I think the NVIDIA chief is saying, you want to be a plumber. And that's what that data is saying. I'm looking at Solano, the chart. So George is now in New Orleans, but I've got Trader Mike. Who is Trader Mike? Let me explain. Trader Mike is Michael. Michael's a great friend of mine, and he spends half the year in St. Bart's. And what he doesn't know about trading, you don't need to know. He's a phenomenal moneymaker. And the last 18 months, oh my goodness. I mean, he is making an insane amount of money. He is not liking markets here. And like all great traders, I was talking to him, and he immediately was hitting me with today's trade. And he was making up the numbers. Why do we all make up numbers? It's like, it's down 60%. Got to buy stocks down 60%. Got to buy indices down 60%. And that's what we're trying to do with the long end of the Treasury market, which is suddenly halved in value, in price. Value, I don't like that term, value, but the price has certainly fallen 50%. Solano, unless you are 2 times leveraged, however, has not dropped 60%, but it has dropped. And my goodness, when you look at how it dropped earlier this year, I mean, it dropped the best part of 90% into the April lows, which I think actually I was quite fortunate in capturing. But since September, mid-September, it's dropped the best part of 40%. And Trader Mike is buying now. Typically, Trader Mike and the profits that he has enjoyed, his favorite setup is like a really good company. So again, let's say a Martin Marietta, which is not a great example, but if Martin Marietta fell 40%, I mean, cement and construction, the aggregates business, I mean, it ain't going anywhere. Like AI is not going to be replacing cement. And a 40% decline would be a kind of very interesting point to start engaging with a long position if you didn't have one already. And like if it fell another 10, 15, 20%, you'd be a buyer. It'd then be down 50, 60%. You'd be a buyer of a great company. So Trader Mike has pursued this strategy, pursued it very well with ASML, the Dutch lithography technology, unique, one-of-a-kind business. The world of high-end semiconductors. We did discuss TSMC, Taiwan Semiconductor. Would not exist without our Dutch friends and their lithography. But the selling of these machines, they cost us a small princely sum of hundreds of millions of dollars. Am I making that up? But they are lumpy, and they have the circus of quarterly earnings, and so there is earnings variability. The business remains robustly one of a kind and wonderful, but the profits can be all over the place. And so the share price can certainly move, can be down 40%. And there was a period like that earlier this year. And so he was very happy to take a long position and to do a covered calls are arguably one of my favorite positions. The covered call is you've got what you believe to be a well-researched. You're very clear in your mind. This is a one-of-a-kind business. And it can be one-of-a-kind for many reasons. It has suffered the indignity of a large fall. There's a panic, but you've got decades demonstrating that this business is one of a kind, and that it's simply an unfortunate timing sequence rather than a change in technology. Like I say, there's not going to be a change in technology that I can conceive of which would affect Martin Marietta, and there's certainly nothing conceived of just yet to take on the lithography of the might of ASML. So down 40%. He is owning the stock. And again, very much, he's happy to take the long risk, because if it falls 10, 15, 20%, there's only one thing you want to do. You want to buy a lot more. And so imagine that was today, that they had reported earnings today and it was down 40%. Yeah. He'd be saying, yeah, but in this market environment, I don't think it's going to make new highs for a while. I think it's going to be choppy and it's going to go sideways. And so what he would do is he would go into the weekly expiring options and he would sell upside calls. And he'd do that every week. And you'd be making between 4 and 5%. Maybe 5, you wouldn't be making 5 in ASML. The vol's never that high. But there are stocks, and that's what he does. 4 to 5% a week. And he did that very successfully with the ASML. But then the regime changed and it actually broke out and it went higher. And so that's a pricing mechanism for a stock that you think is going to be in a trading hold pattern and where the volatility is very high. and you create a very high income, fall into income strategy. I made a complete hash of the Estee Lauder in that there's a kind of want to say a one of a kind. There's a moat there. There's so much invested in that brand. It will come back. The share price down. What did we say? 60 odd percent. Is it going to go back to highs in the here and now? No. I mean, it could. It could. I mean, we looked at the valuation of Estee Lauder, and it was not cheap. It was not sufficiently lowly rated to create very, very high expected returns for asset capitalists. But being down as much as it is, if it falls 10, 20, 25%, I want to buy more Estee Lauder. So it's a kind of covered call notion. The problem is the volatility on it is very modest. And so, yes, you could sell. And actually I would. I mean, so again, we've looked at many stocks which have gone sideways for 20, 25 years in Japan. We looked at even Martin Marietta went sideways for 10 years. Imagine every week selling out of the money call, not huge out the money, but near, but out the money calls. I'm completely hedged. If it goes up, then your stock gets called. Completely hedged to the upside liability. Downside, you have to underwrite it, but you're very willing to underwrite the volatility. And really, what I wanted to say with the Estee Lauder trade was, imagine that it does that for the next 5-6 years by constantly selling the upside weekly expiring calls. You might actually, over that period, get enough income back whereby your entry cost for your long position might be very, very, very modest. That's what I was trying to say about Estee Lauder on Friday. I think I'm going to wrap. It's one of those things when you've got nothing to say, you end up saying too much. I'm looking at my notes to see if there was anything that I'm neglecting. There was another good article talking about AI and change and how things don't really change. And another wow was print sales, physical book sales, the last 10 years. Amazon's a $3 trillion company. And yet physical book sales are still 80% of the US market, according to the Association of American Publishers. Total physical book sales have kept growing. Last year, there was more than 3 billion books sold. 9 books for every person in America. That's a great statistic, isn't it? 9 books. Well done, Americans. You're well read. I wonder how that compares to the French or the Brits. So Americans are still reading books in the physical form. And we're still driving dirty combustible cars. Toyota, which is a really amazing price job, continues to build cars on the assumption that many drivers still prefer the rumble and the smell of petrol cars to the silent, odorless alternative. It's funny, when my ex-wife was in my Defender, she's like, this car stinks. I was like, this car stinks of masculinity. It's called diesel, baby. Suck it in. Anyway. Oh, yeah. George, there's me giving George Gammon, giving him a lesson. The pairs trade, and having seen so many hedge funds blow up with pairs trades, and you blow up, you think you're short, and the thing that blows you up is like 3 standard deviation events where the market actually falls 9, 10, 11, 12%, and you end up you lose money on your short rallies, and you lose money on your S&P long because it's down 10%. I spent the weekend with a former girlfriend who said, hey, let's meet up. And in parenthesis, she had, but as friends only. George was telling me it's called the shit test. And you're meant to say, get out of here. I'm over you. I failed the shit test. All I could remember is just how hot the lady was. I saw her. She came over to the Blanc Bleu. We drank some dark and stormies. But the weather remained cloudy. And I was just enormously annoyed at myself for being so weak. I spent that evening chasing ladies in St. Bart's, determined to absolve myself for being such a weak man. I wake up the next day. God, I did no reading. And with George, I socialized. I was out for the first time in months. Not months, in 2 months maybe. I drank alcohol, not a huge amount, but my new drink, mezcal, sparkling water, and God, I can only think in French, citron vert, lime juice. And twice I went to a Thai restaurant, but I went here, I went there, looked to girls, spoke to girls, with no luck. And the next day I wake up, I was like really annoyed at myself. And the next day I wake up, and there's a message again from the former girlfriend. She's like, "You want to go paddle surfing, paddle boarding?" And what's the right answer? What's the shit test answer? No, get out of here. What do? I spent Sunday paddleboarding. And then finally, and this will end, but you know, I take her for lunch. I do not know what is high. I do not know what is low these days. But I go to La Carite, a French beach club. I rent two, we call them that's two sun loungers. It's $100 each. I think I'm on the beds for no more than 90 minutes. Lunch consists of ordering 2 starters each and 2 alcoholic drinks. What is the bill for that, ladies and gentlemen? What is the bill? Dun, 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 dun. Is it high? Is it low? It was 400 euros. Oh, and parking is now $25. 25 euros, so even more than $25. So it was almost like, it was like $500 for lunch. And we're friends. I mean, not that has anything to do with it. Is that a high number or a low? Trader Mike was telling me, yeah, that he finds St. Bart's actually cheaper than a lot of places that he has been recently in America. Write in and tell me. Get right in and tell me what I should do with the lady. I know what you're saying. Do not see her again. I hear that. I will keep you posted. Maybe I'm going to say goodbye, Warren. To the idiot, my friend, I join you when it comes to the ladies. The guy who sees the future sometimes. But when it comes to the ladies, I'm an idiot. Anyway, to all of you. Oh, and actually, there was one thing so one of you, I shared messages today with a wonderful chap, anonymity and all that, but a musician in a wonderful band. I'm going to say Scooby Snacks, and he was saying, I was asking, hey, what should I say? And any requests? And he was saying, pieces of advice, financial advice that should be taught at university, at school, elementary school or whatever. What can you say? Like save with young, put money into stocks, not into boring stocks. Take a lot of risk, buy things which are volatile, but they're trending higher. Buy things going up. And have enough whereby you don't trade it and hold on to it, I think would be the advice. But I was also trying to, and there is no way you can actually codify trading I mean, there is clearly, given the astonishing success, we were talking about Jim Simmons and Renaissance and these quantitative funds, which are working on rules-based strategies. But I want to think of you as the manifestation of risk is a setup like today, where the 1 year moving average, which is it's the tortoise and the hare. And the hare's winning. And the 1 year moving average, I believe today, the 1 year moving average is 13, almost 15% above where it was a year ago. I'm using 252 trading days. And the hare, the spot price of the S&P is trading 13% above the tortoise. But for the tortoise to be up almost 15%, I mean, that's almost like being a hare. So the tortoise is metamorphosizing into a hare, and the hare is even more hare-like above it. That's to my mind the manifestation of risk. You are underwriting the inevitability that the spot price of the S&P will trade closer to the 1 year moving average. And I think the 1 year moving average could kind of top out, its growth rate could kind of top out around these levels. And so the combination of that would be kind of, again, something similar to what we saw earlier this year, 20-25% drawdown. Would not mark an end to the market. It would be the natural progression of what we see in Meltups. It would be mean reversion. Meaty, severe mean reversion. But you kind of, if you are seeking to better yourself and your knowledge in trading, you want to be the person that can actually be a buyer and not be the poor sod that has to sell. Good night, my friends, or good morning, and I love you. And thank you very much. I am Hugh Hendry. This has been the Asset Capitalist Show. It is dark. It is nighttime. It is 11 p.m. I have spoken over an hour again. Good night. Good night. Good night. Good night.